part of David Wilson's expertise in his book as well is a huge respect for at least studying what was canon in the old days, going back to Richard Russell and to a guy named Joseph Granville was a dreaded AD line or the advanced decline line. No one cares anymore except Dave Wilson.
Well, I wouldn't go that far. I'm sure that Liz Ann Saunders cares over Charles Schwab because today's chart is a version of one that she had out yesterday. Looking at the S&P 500, which has been setting record after record, relative to a cumulative AD line, so you're basically taking daily totals and adding them up, for stocks listed on the New York Stock Exchange. And the stocks part is important because you can do the same thing with NYSE securities, which include bonds and preferred shares, and it kind of skews the figures to some extent. If you look at the cumulative AD line on NYSE stocks, it peaked back on June 8th, and it's kind of been, falling a bit since then. Even though it's come back lately, I mean, we're talking about a period since June 8th where the S&P 500 has set records 20 times, with the latest one yesterday. So the concern here is that there's a bit of a divergence going on that, perhaps signals that, the strength we're seeing in the S&P 500 is not necessarily all it's cracked up to be.
What's the distinction between the two indices or the two sets of stocks? Is it like weak financials, or is it one has Apple and the other doesn't? How's that work?
Well, I mean, since we're talking NYSE, it doesn't have a lot of the big tech companies, the Apples and the Microsofts of the world. So, that's certainly an explanation. Beyond that, I mean, you're talking about, a lot of older line companies, the kind of value stocks that had done well.
Richard Russell knew.
Yeah, exactly. That had done well for several months and then kind of faltered lately as we saw investors go back to, their previous favorites in big tech and elsewhere.
Dave, do some of these traditional metrics, these traditional canaries in the coal mine still work in an era of the QE that we see, in an era of such low rates?
Yeah, I mean, that's the question because, it's funny. You can actually stand the S&P 500 on its head, so to speak, and look at what's called a reverse version of the index. And, it gives the most weight to the smallest companies. And we're seeing that indicator set records as well. So, you do have to wonder because you think about the smaller companies may well be bigger beneficiaries of what's going on in terms of government spending at this point. So, it does kind of raise a question, at least, about, what the broader kind of market indicators are really telling us here.
A theme over the past few weeks for us, Dave, have been the revisions upward to S&P forecast for year-end and into 2022. We're going to be speaking with David Kostin from Goldman Sachs, who also joined the train of upgrades. Is that the norm now? I mean, for analysts who you speak to who have yet to come out with public calls, is this the question? We haven't gone high enough, or is there continuing to be this bearish kind of overhang of concern among a lot of analysts?
Well, I mean, yeah, there's a certain amount of concern, no question. But the really interesting part to me of seeing all these forecasts is you don't tend to get them historically until maybe November, December, when analysts have had the opportunity to kind of pretty much see how the full year has gone. And then they weigh in on the following year. I mean, so the idea that Goldman Sachs and Credit Suisse and your Denny Research and others are out with these 2022 forecasts in the middle of August, I mean, it's a difference. It's like they're moving up the timetable. They're so confident at this point that they can go ahead and make projections for next year, even though we still have a fair chunk of this year to go.